Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. Today, we will talk with Professor Campbell Harvey, a professor at Duke University and a research associate at the National Bureau of Economic Research in Cambridge, Massachusetts. Professor Harvey obtained his doctorate at University of Chicago Business Finance, and he then served on the faculties of Swedish, Finnish, and American universities. He's a fellow of the American Finance Association, and it's also a founding director of the Duke CFO Survey that has watched quarterly survey polls for over 1,500 CFOs worldwide. Professor Harvey, thanks for being here.
Thank you for inviting me.
Before we start talking about decentralized finance, which is Professor Harvey's main topic, I first wanted to ask you about a topic that I've also seen you've studied a lot, and it's yield curves. Currently, we are in an inverted yield curve, and this usually precedes economic recessions in the U.S. But nonetheless, an inverted yield curve does not necessarily imply that a recession is coming. So what is your view on the current and future financial situation?
Yeah, so I didn't expect that question, but it is appropriate that I'm answering this question in Toronto because the genesis of my inverted yield curve idea came in Toronto. And most people don't know the story where I took a summer job as a first-year master's student at a company called Falconbridge Copper, at the time the largest copper miner in the world. And I walk in as this first-year intern with essentially no business experience, and they tell me my singular task during the summer is to build a model that forecasts real GDP growth. And I'm thinking, well, no big deal. But looking back, with a few more years of experience, I realized how ludicrous such a task was for somebody that had no experience in building models like this. And at the time, I knew that I couldn't compete against these econometric companies that were charging $50,000 to $100,000 a year for a GDP forecast. They had dozens of PhD economists, computing power, data, and I've got like 10 weeks to put a model together. And what I did was to use an insight from a professor at the University of Chicago that, well, maybe we don't need all of these equations. Maybe we just need to look at asset prices because asset prices actually reflect future information about the cash flow. So think of a stock. The stock is the discounted present value of expected earnings. And obviously expected earnings are correlated with the business cycle. So I'm thinking, we'll look at assets. So I started to look at stocks and then read more from this faculty member at the University of Chicago, and stocks were just super unreliable. And they were giving false signals, like more false signals than accurate signals. And I tried to figure out, why is that the case? Like the idea of looking at asset prices and the price today reflects not the past, but the future. That's a great idea, I think. So I started to look at bonds. And bonds are different than stocks in a key way. So both the bond price today, that reflects the future cash flows, just like a stock. But think of the difference. For a stock, who knows what the dividend is actually going to be? With the bond, you know what the coupon is. With the stock, who knows what the maturity of the stock is? Like when do those dividends end? Well, with a bond, you know exactly what the maturity is. And then the last thing, we discount those cash flows to get the stock price or the bond price. But the discount rate for stocks, who knows what it is, and it reflects risk that could change in the economy. But with the bond, it's relatively risk-free. So I'm thinking the bond is what I want to look at. And I looked at the bonds and the yields, in particular, the term structure, so the difference between long-term yields and short-term yields. And it was remarkable that it moved with the business cycle. Indeed, it moved ahead of the business cycle. And then looking at the economic theory, oh, wow, this is like basic stuff that, look at the nominal interest rate. It's got three components: expected inflation, expected real rate, expected risk. The risk is low for government bonds, but that expected real rate, we know from basic economic theory, is correlated with economic growth, real economic growth. So I put it all together in Toronto. I'm about to present to the senior management at this firm, and my whole division was laid off, which was shocking to me. The summer intern, like maybe I can understand that happening in the US, but I thought in Canada people were a little more friendly. But no, I'm laid off. And there's no time to find another job. So I just worked on this idea. And when I went back for my second years, my professor said, you need a PhD. And then I submitted the paper to the University of Chicago in application. And eventually I polished it, my dissertation. People were skeptical a little bit because it was really only 4 observations. One thing with recessions, there's not that many of them. And it could be lucky, but they signed off. They really liked the idea that my model did better than all of these incredibly expensive forecasting services. It was so simple, just a single variable. So since that's happened, we've had 4 additional recessions, and each one preceded by an inverted yield curve. So the model is 8 out of 8 without any false signals. I'm not naive. I know that this simple model at some point will fail, but it hasn't yet. And given we've got an inverted yield curve, we need to take that very seriously. There are some differences, in particular with respect to the linkage to financial institutions.
Okay, very interesting, Cam. And talking about that, in one of your courses, you mentioned that what we need in the financial system is not only a renovation, but a complete rebuild. So why do you think our current financial system is failing right now?
So our financial system, and when I say our financial system, I'll talk about both Canada and the U.S. So in the U.S., it's a different financial system than Canada, but there's a lot of similarities. So Canada's banking sector is oligopolistic, in my opinion. And I guess the people that are involved with that system really like it because it's been very profitable, extracting rents from average Canadians, but at the cost of economic growth. And that's too bad because we really need that economic growth. So it imposes certain constraints. In the U.S., even though there's thousands of banks, it's really the big banks that dominate. And similar to Canada, it's very oligopolistic. So the financial system has failed in multiple dimensions, and often we just don't see it. It's not tangible. And I'll give you a couple of examples. So one example is somebody comes in, entrepreneur, they've got a good idea, and it needs to be financed. They go to their bank, pitch the idea. The loan manager likes the idea and says, I really like your idea, but we would prefer to do business with a company, a larger company, rather than like 100 people like you. So we're not going to give you this loan, even though we like the idea. But given you're a banking customer and given you have a credit card with us, we're going to increase the limit on your credit card, and you can borrow on your credit card to finance this really good idea. Well, we know what the borrowing rates are on credit cards, and they're punitive. And what does this mean? This means that that project is not pursued. This is perhaps like a 20% or 25% return on investment project. Those are the types of projects that we need to spur economic growth, and they're not pursued. And this is just smacking of like market power for the banks. So we talk about those that are unbanked. And there are 1.7 billion people in the world that don't have a bank. But it's not a number that's known. And this is the number that are underbanked. And I gave you an example of an entrepreneur that's underbanked. So this is like a real issue. It's a financial friction that costs us in terms of economic growth. So again, these banks have market power. Here's another example of their market power. So I was in my bank in the U.S., which is a too big to fail bank. I got in the mail this notice of auto renewal of a certificate of deposit, a 5-year certificate of deposit. And it said, was auto renewed. And I looked at it and I said, oh man, that interest rate is low, 2%. How can that be, for 5 years? Then I looked at it in more detail and I misread it. It wasn't 2%. It was 0.02%. So 2 basis points for a 5-year lock. So I called my bank, and then I give advice to pensions and endowments and hedge funds and all this stuff, financial advice. I'm not very good at my own personal finance. I will admit that. But in this particular occasion, I'm talking to my too big to fail banker, and I said, what is the interest rate that I'm getting in my savings deposit? Like, I know in a checking deposit, it's probably 0. And they said, well, you're getting 0.02%. And I'm thinking, oh, you got to be kidding. The interest rate is over 5%. So this is orders of magnitude lower than just a market rate. And those that don't check to see what their rate is and just taken advantage of by these banks. So then you think about what happens. So I told them I'm going to withdraw every nickel and dime and penny out of that account and put it into a money market account where I can get like 5.3%. And they did that. And you think about it, it's just like they're taking advantage of those that don't really look carefully at their finance. There's a lot of people like that, and it is really unfair, their market power. So not only are they causing problems in terms of the sort of selective credit that they give out, this is a way bigger problem. And this is the sort of problem that decentralized finance tries to deal with, where in decentralized finance, everybody is a peer. So there's no banker and customer. There's no retail investor and institutional investor. Everybody's a peer. And everybody is banked because your wallet, your smartphone, and they do stuff with it. So in March of 2023, Silicon Valley Bank goes down. So why did it go down? It's pretty simple. The customers put money in, and then the people at the bank invested that money in treasuries, and they decided that the rates on the treasury were pretty low, so they decided to go longer and longer term to get a higher yield. But we know that longer term bonds have more risk. So a small change in the interest rate could have a dramatic effect. So they got greedy and they increased their own compensation, the executives in Silicon Valley Bank. And when rates went up, their equity went negative, and the FDIC had to come in and shut them down. So that wasn't fraud. That was just greed and gross risk mismanagement. So FTX, Silicon Valley Bank do have a lot of similarities here, given that both of them kind of deal with the failure of risk management and what can happen. For the Silicon Valley Bank, these executives that went offside and gambled the customer money on a higher risk investment, well, they're not on trial right now, but it's not a good situation. And it's especially not a good situation because the government bailed them out. So I go to a bank, I know it's insured up to $250,000, and it put $25 million in. Well, that's taking risk. And I've got a choice. I can carefully monitor that bank, but I cannot expect, if I don't monitor, I cannot expect that the government should just bail out every single time. And that's exactly what happened this time. So what does that mean in the longer term? Well, it means other banks should do the same thing. That they're called too big to fail. So it means that they can do what they want. And yes, there's a regulatory structure, but it fails routinely. It failed in March. So the FDIC knew what Silicon Valley Bank was doing well before they failed and called them out, but then did nothing. And on top of that, we've got in the US at least these stress tests, which don't make any sense. If you're given a stress test where the adverse scenario is so unrealistic compared to where the Federal Reserve takes the policy, that is unfair. So you've got regulatory dysfunction, but the bottom line is that our financial system needs repair. There's this idea, and I was just at the University of Chicago, it's called the Chicago Plan of 1933. And I really like this plan. And this plan is for kind of the centralized system, but the idea is that banks should be narrow banks, which means you put your money to a bank, they don't actually lend it out to anybody, and they don't have a maturity mismatch. They just send it to the Fed, and it sits in excess reserves, and there's no chance of that bank failing. It's completely safe, and you collect interest, whatever is paid on the excess reserves. And for kind of business loans and other loans, you have a firm that specializes in it, a firm like Blackstone today. And private credit has become more and more popular. So the investors actually lock their money in for a longer period of time, and there's a match with the loans that are made. So you're naturally hedged. So I think that we're kind of moving in that direction slowly. Of course, the big banks don't like any of these ideas. They just want to preserve their position. So you've got that happening, and then simultaneously, you've got the decentralized finance happening, which is very encouraging because decentralized finance solves so many problems potentially, including financial inclusion, financial democracy, security. There's just a long list of stuff that is solved with this innovation. So to me, in the future, I see that the bank's market power will be greatly reduced. The monopoly in the U.S. that the U.S. dollar has for payments, that will be broken. And Canada is kind of interesting because you've got essentially two currencies where many Canadians have U.S. dollar bank accounts, but that's only two. In my vision of the future, we've got dozens, if not hundreds of ways to pay, and you kind of break that monopoly. So we've had the same banking system for over 100 years. It is time for renovation. The debt of the government in Canada is substantial. The debt in the U.S. is very substantial, $32 trillion. There are three ways to pay off the debt. So number one, raise taxes, and nobody wants that, and that's toxic for economic growth. Number two, print money. And that's kind of like number one, because you create inflation, and that inflation is like a tax. So nobody wants number one, nobody wants number two. Number three is the best, and that is increase economic growth. And that's the way to pay down this debt. So we need to actively focus on innovation, breaking these frictions, reducing the monopoly power. And it's not just the banks. We're faced with monopoly power all over the place, whether it be our mobile telephone provider, our social media. There are monopoly and oligopoly powers all over the place. And we know from Economics 101 that induces a deadweight loss and it holds back economic growth. My own academic research looks at the relation between economic frictions and financial frictions and real economic growth. And the results are not controversial. The evidence is very convincing that if you reduce these frictions, there is a dividend that you get in terms of economic growth. So I think that given the changes that we're seeing in our financial system, again, the banks will oppose all of this stuff, and all their lobbyists and politicians on the payroll, they don't want anything to change. This is just a gravy train for them. But the pressure eventually they will just, will have to deal with. And I see the possibility of substantial renovation in our financial system by reorganizing the centralization and then also decentralized finance playing a big role. And just let me say the last thing, I'm not a believer that everything will be decentralized in the future. My book, DeFi and the Future of Finance, makes this very clear, that there are certain things that are much more efficiently done in a decentralized manner. But there are other things that need to be centralized. And one thing is credit. So credit doesn't really exist in decentralized finance. So we'll always have some degree of centralization, but we need to make it much more efficient.
Great. Thank you very much. That was very enlightening. And I'm going to create a short summary of a couple problems that you mentioned, including, for example, middlemen that are being inefficient, regulations that aren't providing the best for customers, decentralization, as you were mentioning, and also the lack of transparency. And as we saw, DeFi is the new transformative and rapidly evolving concept that's going to leverage a lot of movement in the fintech industry. So I want to ask you specifically, how can we use things like blockchain technology in enabling this DeFi ecosystems and make them a game changer in the fintech industry today?
Yeah, so game changer is, I think, an appropriate term. It's kind of a cliche these days, but nevertheless, this is perhaps like an appropriate application. And you mentioned transparency, and this is really important because there's this famous letter from Senator Elizabeth Warren to the Treasury Secretary Janet Yellen, where she complains that DeFi is this niche space in the crypto world that is incredibly opaque. And it's like, no, whoever wrote that for the senator doesn't understand basic stuff in decentralized finance. So decentralized finance, by definition, is open source. So you see all the code. You see if you're doing a transaction with somebody, you see what their balance is. So you can see that they can actually pay if you're being paid. So this is kind of the opposite of what Senator Warren was saying. And what's opaque is our current banking system, where, before March, Silicon Valley Bank and banks like that, these were kind of high-flying banks, and people thought that they were healthy. They produced reports. The FDIC signed off. But when you actually went into more detail, these banks were in serious trouble. So it's our current system that is opaque. So I do think that this idea of transparency is really important. And for fintech, this is, and as you know, decentralized finance is one aspect of financial technology. Most of the fintech, though, is centralized. So that's a difference. So in decentralized finance, there's not necessarily a company involved. There might be a decentralized autonomous organization called a DAO, where you vote on various changes. So think of it as like an annual general meeting of shareholders every day. And those that have the governance tokens do the voting. And this is like a different model. And as I said at the beginning, within this space, you don't delegate ownership of your tokens to a broker or an exchange or anything like that. You retain. And another great benefit of this technology is the interoperability. So if I want to set up a brokerage, let's say a Robinhood account, I need to get my money to Robinhood. So I need to do like a wire transfer, which in the US could take 2 to 5 days. So that's not interoperable. So in the decentralized finance space, I've got a wallet, and the wallet is either on my phone or my laptop. I go to an exchange and I connect wallet, and I'm ready to go. That's it. That's all I do. I don't need to register or anything like that. I'm ready to go. And another key innovation here is that usually when you, let's say, trade a stock, you can buy the stock, but you don't actually get the official ownership of it for a couple of days. And that's called the settlement. So it takes 2 days to settle. And come on, in the day of technology like this, that you need to wait 2 days for settlement? So in decentralized finance, the execution of a trade and the settlement of a trade are identical. And you mentioned back office and middle people. No, the back office is a blockchain ledger. That's it. And that's all you need. Is your back office has been replaced by a ledger. So again, this is something that can greatly increase efficiency. And the last thing that's important is this idea of open source. And I'm not sure that people fully appreciate this, that we've had great technological innovation in terms of computing speed. Indeed, my graphics card does 32 teraflops. That is just stunning. So 32 trillion operations per second. That's great. And we've got lots of data and data storage. But there's a third aspect that's really important for fintech, and that is open source code. So that means you can look at something, especially in decentralized finance, and say, well, I can improve upon that. You copy the code that's already out there. You add something rather than reinventing the wheel and starting from scratch. It's already there. So the speed of innovation has increased just dramatically because of open source code. So there are so many opportunities here in this space, in the fintech space in particular. You've got this ancient system that really isn't much different in terms of the banking world for the last 100 years. You've got many of the big banks have a code base in this ancient language that really hasn't been an active language for 30 or 40 years, called COBOL. When I was a student at the University of Toronto, even then, COBOL was an ancient language. Yet many of our financial institutions have millions of lines of COBOL. And it's super difficult to make a change. It's really hard to innovate when you've got this giant code base. So the fintech, they don't care about the million lines of COBOL. They're going to start out on their own, fresh. And that's what we need. So we need a renewal. It's difficult given that all of this stuff is so entrenched. And in Canada, actually, I believe the problem is even more significant given the current oligopolistic banking system. That is something that appears under the radar. People just used to it. It's just like using Google or YouTube. You're kind of used to it. Oh, well, I get a free email system. But they don't realize the thousands and thousands of dollars that are taken from them by all of the ads, their data is sold to advertisers, and they get nothing from it. So it's just another example. I could go on. There's so many examples here of these large firms that are extracting rents, that are holding back the economy, and we need to change that. I believe that fintech, decentralized finance, artificial intelligence will alter the world, and fairly rapidly too. So my horizon is not 25 years. My horizon is 10 years. And we're going to have a very significant transformation. And if Canada doesn't play along, they'll be a loser. They'll be left behind. And I don't think anybody in Canada wants that to happen. So we need disruption. And we need the regulators not to fight it. So if you are extreme in terms of risk management, try to reduce all the risk. We kind of know what happens in finance if you do that. Well, you just buy treasury bills, and we know what the returns are on those. So we need to take some risk. We need to fix our system, and we need to get the middle people and these oligopolistic players in a position whereby they're acting for the country rather than themselves.
Thank you very much, Cam. This was a great interview, and I hope everyone listening learned as much as I did. We'll see you in the next episode.